No surprise there that in the fourth quarter, a lot of the fears of the fiscal worries that we saw from the Eurozone started abating. And perhaps, yes, we did see issues coming through from Ireland, but a lot of that news had already been priced in. So overall, positivity, one would say.
Yeah, absolutely. I think what strikes me with this number is how little impact the European debt crisis actually had on South Africa and on emerging markets in general. And if we look at something, for example, like the VIX index, which is very much a measure of volatility, it's known as the fear factor index. It really just kind of remained fairly stable in the fourth quarter. And I think what we saw was, to a large extent, this kind of bond market panic, but very much isolated to the European context. Yeah. And I don't think it had too much of an impact outside of that context.
Now, although we saw a lot of resilience coming through on the equity front in the fourth quarter of last year in South Africa, we saw strong bond outflows. I know particularly from the beginning of November, that theme now still filtering through. And it seems that emerging markets perhaps not so much in vogue anymore as what the developed market is. And this is why we're starting to see a lot of changes in perceptions once again as we head into the new year.
Yeah, I mean, our view is that this is a temporary issue, so we don't view this as a fundamental change of perceptions. If anything, the long-term fundamental change remains that the core is now becoming not the core. In other words, what is considered the periphery, the emerging markets, Africa, Asia, South America, continues to offer very attractive investment spreads, interest rate spreads relative to risk. And in fact, just yesterday, Bill Gross of PIMCO wrote on exactly this issue. So I think that's the longer term trend. We're definitely seeing a short term kind of pull out of bond markets in emerging markets. And to a large extent, that's why we're seeing equities doing so well, because there's this rotation play going on. To the extent that bond markets are suffering, equities are kind of the next best thing, and that's where a lot of funds are flowing.
Well, just looking at the play between bonds, the money market and equities as well, also interesting to note, when you look at equities, as you mentioned, we're seeing an upweight there. Money markets, downweight in cash holdings, also quite interesting to note. And perhaps you mentioned in the article, not with as much conviction as before, and bonds also not something that people are looking to at this point in South Africa.
Yeah, and I think what's interesting about the confidence index from the fourth quarter is that it continues to show foreigners far more upbeat about equities than locals. We're actually seeing locals are moving back into equities, local funds, but you're absolutely right, the conviction is not quite there for a wholesale move back in. So at the very least what that tells us is that there's still a lot of scope by historical standards to shift out of cash and bonds into a place like equities.
Well, let's look into the first quarter of 2011, and since the beginning of the year we keep hearing about foreigners selling out of the bond market. The equity markets are going higher. We're not really sure if foreigners are buying or whether it's locals, local retail investors as well. But Russell, the theme going into 2011 with renewed conflict in emerging markets, we see what's happening in North Africa and the Middle East region as well. How is that going to affect investor confidence overall?
I think it's overall, there's no question that any kind of turmoil like that in emerging markets will have a dampening effect. But I do believe that investors are becoming far more discerning about which emerging markets they invest in. So there's definitely an appreciation for the differences between a South Africa compared to an Egypt, compared to a Syria, or whatever it might be. So overall, I think that locals will continue to be relatively well disposed to equities. I think that foreigners, after a short period of time, are going to continue to put funds into emerging markets. The one concern is the leading indicators in South Africa, which suggest that real economic growth could start to taper off. And I guess if there's one hope for growth in the early part of this year, it's that we get a lift from the offshore economies that look as though they're starting to show signs of growth. So I don't see a big tapering off in investor confidence, nor do I see a big rise. We're kind of stabilizing at the moment around very neutral kind of investor confidence levels, and I think that's very reflective of the sort of uncertain environment that we're in.
And I suppose at a time where we're so close to an all-time high reached, on the JSE All Share, and apart from that, we're also seeing a weakening currency. What is going on with the rand at this point? We're sitting at around 7.30 to the US dollar. We started the year off, I think, at around 6.58 to the greenback. We've seen bond outflows. At the same time, we're seeing equity market rises.
Yeah, I mean, look, stock market is generally going to rise on a weaker currency, and that's not just a South African issue. that's across a number of countries. So I think the fact that we're seeing a run-up in equities makes a lot of sense. The weakness in the rand we view it as a very short-term effect. I think to some extent in December we strengthened far too much, far too quickly, and we're seeing a clear out of the weak hands, if you could call it that. This is a classic market clear out, but if we go beneath that, if we look at what we've been talking about for a long time now, the fundamentals remain in place. Now, of course, there is an issue with talk that the Reserve Bank is intervening more heavy-handedly in this foreign exchange market. I think that's something we need to monitor going forward. But certainly, underlying fundamentals for us haven't changed. And just like last year, when we saw periods when the rand traded down to 750 and then quickly back up to 8 rand, and people said, right, that's it, that's the turning point in the currency, and it wasn't. I think we're seeing a similar episode now. We've seen a sell-off, a clear out, ready for the next, long-term.
So bounce back to 650 or so. Is that what you're calling? What level?
I certainly think that getting back to 650 is possible, and I think beyond that we would need to see a meaningful break below that. Before the market gets more conviction of going towards
but
the
Russell,
6 rand
I mean,
level.
we're talking about the Reserve Bank accumulating reserves. We're going to have reserves released on Monday, which are going to be quite telling in terms of how much they've been accumulating. What kind of levels are we looking at here where we say, okay, this is really going to be impactful on the rand, and we could see significant weakness because they are accumulating so aggressively?
I would say that if we look at a Reserve Bank that's accumulated anything less than sort of $500 to $1 billion on the month, that would suggest to me that there's not a lot of intervention going on. But if we see $1 billion to $2 billion or even more of FX accumulation, that would suggest to me that the Reserve Bank is getting far more heavy-handed in this market. And I think it would certainly be telling, and I think the market is very much waiting for those figures.